afternoon, everyone. My name is 𝗂𝗲𝗏 from Targa Communications in the UK, and I want to welcome everyone to this Investing in Germany Roundtable regarding data centres. We are very grateful to the German Data Centre Association, which is supporting this event today. Back in the mid-1990s, I was instructed to dispose of an empty office building for IBM. One of the biggest selling points of the building was that it contained a fully functional data centre that had, at that time, been home to one of the most powerful computers in the whole of the UK. I suspect that today my mobile phone probably has more processing power than the mainframe computer that had been operating from that building. The truth is that this data centre was probably less than 50 square metres in size, and much of that space had been used for air conditioning. It certainly wasn't the most attractive of buildings. Today, data centres are still not pretty. They're often big metal boxes and often mistaken for industrial or logistics properties. They are, however, far more important these days because they've become essential to how we live. They house the technology infrastructure that dominates so much of our lives, from communicating with our families, friends and colleagues to shopping online and working remotely. I wonder how many data centres are playing a part in allowing this roundtable event to be broadcast today. Society's reliance on data and the emergence of 5G technology means that the demand for data centres is only going to increase. And because of this, the investment opportunities from the real estate perspective are highly attractive. But there are barriers to entry to the market. There are particularly high infrastructure costs, which means that data centres are expensive to build. Another concern is the pace at which technology is changing, so obsolescence and maintenance are factors that must be considered. And like much of real estate, a great deal is about location, location, location. To uncover the opportunities and challenges for investors looking at the German data centre market, we have assembled a panel of experts for you today. We are joined by Jonathan Aitken, Global Head Communications Infrastructure Investment Research and Managing Director at RBC Capital Markets. Jonathan is based in San Francisco but joins us today from Paris. Our second guest is Paul Lewis, who is Director of European Data Centres at Principal Global Investors in London. We are also joined by Catherine Motlagh, who is EVP and Chief Financial Officer at Cirrus One, who joins us from Dallas in Texas. Good morning, Catherine. Our final panellist is 𝗂𝗗𝗄𝗏 Müller, who, as well as country manager for Keppel Data Centres in Germany, is also an executive board member of the German Data Centre Association. He wears many hats. I would like to extend a warm welcome to all our panellists. We'll now hand over to Charles Kingston, the editor of REFIRE magazine and our lead moderator, to start today's discussion. Charles, over to you.
Good afternoon, everybody. Andrew, thank you very much indeed. And welcome to our first REFIRE Targa Communications roundtable discussion on data centers. In fact, I'm not sure if this isn't the first general discussion on live on data centers here in Europe among investors and all those who are interested in this in the segment. As Andrew said, this is it is a complex sector, and therefore we're very glad to have actually four speakers this afternoon who've got such an amount of bundled experience in this industry that. By no means are we here the experts, but our speakers certainly are. And I think the goal of this afternoon's discussion is to learn as much as we can about this industry. Clearly, there's a German element to this, but the nature of the data center industry is very international, is very global. And that's, of course, one reason why we've got speakers here from so many different locations this afternoon. But it is an area in which there is a strong German element to this as well, and we'll be trying to learn as much as possible about that. And I would say our goal for the afternoon is, or for this session, is to learn as much as we can about the challenges and the opportunities within the sector, and to see, for many of us who may be listening in and learning about data centers professionally for the first time, what are the opportunities for investors as the sector grows. And it's growing, obviously, in very many different directions. The more I learn about this, the more I realize how absolutely how differentiated it is. And therefore, to talk about it in the sense of one single asset class is perhaps a misnomer. But we're going to find out more about that this afternoon. As Andrew said, I'm the publisher and the editor of REFIRE. Our speciality is German real estate. We publish in English language. We've been doing that for 15 years. So we've been keeping an eye on this industry. But today, this afternoon, I'm hoping that we're going to be able to unlock more treasures that as the sector comes out, crystallizes as an investable sector. Certainly in the last year or so, in the course of the pandemic, the private equity and other investor groups have been looking much more intensely at this and seeing how they can get involved. So without further ado, what I'd like to do first of all is invite all the four panelists, perhaps just to give a quick 2-minute introduction to themselves, what they do, what their angle is, what their interest is in data centers. And let's kick it off from there. Jonathan, perhaps I might start with you. You are known as a legend in the industry. I've read a number of your reports, and there's very little more comprehensive out there than what your research team has been putting together. Tell us a little bit about your own role with RBC.
Thanks very much for the opportunity. My focus when it comes to data centers is global. Including China. And one reason for that is that the drivers of demand outside of China are actually quite similar. It's the same 5 or 6 or 7 companies that are driving the preponderance of absorption, whether you're operating in Frankfurt, Paris, Sydney, Singapore, San Jose, or elsewhere. And so these data center developers, I think, have quite a lot of common in terms of the commercial trends that they're seeing. The operational challenges, of course, differ by jurisdiction, by country, and so forth. But my role is I lead the global investment research team based in San Francisco, but I've got teammates that are based in other cities as well, do quite a lot of traveling to visit assets, data centers, cloud computing, hosting. Another area that Catherine and I actually overlap on is towers as well, an area that I've been involved in, that she until recently was involved in as the chief financial officer of the Latin American part of American Tower. So you mentioned 5G in the beginning, and that's obviously a driver of both mobile infrastructure, but it also helps drive demand for a lot of the data that lives inside of data centers. And then the other kind of piece of the puzzle that's highly relevant is fiber. Fiber companies, particularly in the B2B fiber segment, so fiber to enterprises, fiber to social networking companies, content companies, connect directly to data centers. And a data center that isn't fibered really isn't all that useful. So that's one reason why I focus a lot on fiber infrastructure as an adjacency to the data center focus. So with that, I'm happy to take the conversation in whatever way it goes, and pleased to be on the panel.
Great. Catherine, over to you in Dallas.
Thank you very much. First of all, thanks for the opportunity. And it's good to be here and joined by this panel. Super excited, especially about the region and talk about Germany and Europe. But to give you a little bit of broader perspective, I'm a chief financial officer for CyrusOne. CyrusOne is the owner, developer, and operator of data centers. We own over 50 data centers across US and European footprint. In Europe, we're in 6 different markets, key markets in FLAP-D, what they're known as, and we have a very strong presence in Germany specifically, so super excited about that.
FLAP-D, if I can interrupt, FLAP-D, which will come up again, is Frankfurt, London, Amsterdam, Paris, and then Dublin as an adjunct at the end, right? Got it.
Yeah. Yes, thank you. It's we like abbreviation in our industry, so abbreviations go a long way. So we speak in acronyms. So a little bit about my background is mostly telecommunications, active infrastructure, passive infrastructure, starting from network and all the way to towers. As Jonathan mentioned, we did cross paths in the tower industry, and I was covering the international, and now it's in the data centers. And all of this is an ecosystem that is very heavily related and driven by technology. And what I also like in terms of passive infrastructure to stress your attention is that this is the intersection of technology and real estate. Data centers and towers are the real estate assets utilized and driven by technology developments. And I think that makes a big difference in terms of how you look in those investments and how you understand that business.
Great. And I think it is true. One thing we're coming to see is that there's a real estate element to this, but it is increasingly technically driven as well. Jens, perhaps you might tell us both your dual role here this afternoon, both with the German data center and with Keppel.
Yeah, thanks. And thanks for the opportunity. Hi, from my angle. Hi, everyone. I'm Jens Müller, and I've been working in the data center industry for 20 years now in various management roles on the commercial side. That was at Current, I work as a country manager Germany for an international colo provider with presence in APAC and Europe. But today I will speak in my capacity as board member of the German data center industry, which was formed 3 years ago to promote and represent the interests of the German data center industry, a growing industry in Germany. To pick up one line from Catherine, I couldn't agree more that this is a breed of real estate and IT play. So it's not your usual type of real estate. It's special real estate, and there's a close connection to IT.
Great. Paul, over to you. You're with Principal Global Investors, and you know a great deal about data centers as well over the last 20 years.
Yeah, good afternoon, everyone. Delighted to be part of the panel. Paul Lewis, I'm European Director for Data Centers at Principal Global Investors. I've been with the firm about 3 months now. So Principal Global Investors are a top 10 global real estate investment manager with sort of about in excess of $90 billion of assets under management. They've been invested in the data center sector for about the last 14 years in the United States, having deployed sort of over $1 billion. They're now looking to bring that expertise over to Europe. And so I've joined to be part of that data center team based out of their London office. In my previous life, I was Group Data Center Director at SEGRO, who are a shell data center developer along with industrial and logistics properties. We had a portfolio there valued at about 900 million sterling in data centers, about 30 assets, including 4 leased to CyrusOne. So I have to be respectful to Catherine as a former customer of mine.
Okay, well, that means you've spent a long time also exposed to the classical logistical side of real estate. Now, how different is the data center market from logistics?
I think that's a really interesting question, and I think you're seeing a sort of greater divergence over time. If I look back to my former life when we started developing data centers, it was very akin to the logistics market. Effectively, we were building big sheds and just looking to lease them to data center operators who would do all of that sort of refit and redesign themselves. And we would make very few adjustments to our base build to accommodate that. I think as the sector has matured, you've started to see much more build-to-suit data center design coming forward to make better use of the land that's available, and increasingly good data center land in the major cities in Europe has become more and more expensive. So, operators like CyrusOne have had to make better use of that land given the prices that are being paid, and equally to make the buildings more efficient, both from an operational point of view and also a sustainability point of view. You've very much seen, better quality design, I would argue, come into the data center sector, and it's moved further away from logistics. That having been said, I think, one of the issues we face in Europe is the availability of land. And many of the places that data centers want to be are also exactly the same places that urban logistics want to be. And much as we've seen a boost in demand for data centers over the last few years, you've seen exactly the same in that e-commerce market. So that's driven, again, competition for good data center land across Europe.
Well, that's a very good point, because I think we may have quite a lot of people listening in who have been involved in the logistics market and hence looking at transition from the logistics market perhaps into the data center business and learning as much as they possibly can about it. I'd like to quote a study which came out between Jens, your organization, the German Data Center Association, and PricewaterhouseCoopers, PwC, earlier on this year, where they invited 72 investors and operators to ask them what their intentions were for the next couple of years. 41% said they plan to invest in data centers in the next couple of years. 2/3 plan to invest between 50 million and 250 million euros. 60% said they would invest direct. They may have to graduate onto funds, which would be your business later on, Paul. But they may have unrealistic expectations, or there seems to be a lack of clear knowledge as to what kind of returns, what kind of yields they can expect. Let's just look at all of that. How realistic is it, Jonathan, for this mismatch between supply and demand to come into sync? Are people being realistic about their goals in investing into data centers? Will there be enough opportunities for them, or is there too much opportunity?
I think by and large, if you look at it over a multi-year period, there tends to be equilibrium. There's some markets where supply is tight, demand is strong. So I'm thinking of kind of Santa Clara in the US, Singapore over in Asia. And then there's some markets that in the past have actually seen oversupply. London back in kind of the 2010, 2012 timeframe was such a market. And Santa Clara was such a market as well. And then somewhat more recently, going back maybe 2 or 3 years, Northern Virginia, which you mentioned in the introductory remarks. But an interesting aspect of this industry is that almost every developer has been doing this either for a very long time, or if they're with a new company, they are an experienced executive with one of the public companies, such as a Digital Realty or another operator. So a lot of folks are actually quite experienced, even though there may be new logos entering this segment. And knowing that there's just a finite number of customers, and knowing that the tides can shift between supply and demand quite quickly, I don't see disruptive amounts of speculative development as something that happens very often. It does happen sporadically on a market-specific basis, but I wouldn't say that it's a concern. You mentioned yields, and this is, in essence, a sector where the yields have compressed a little bit. If you take the statements of some of the public operators over the years and look at what they would target in terms of an unlevered return, for a large wholesale or hyperscale type of requirement, that number has gone down from maybe low double digits to sometimes high single digits, maybe mid to high single digits. It depends. But when you add leverage on top of that, and then when you compare even those unlevered numbers to other real estate asset classes, data centers usually compare quite favorably and look quite attractive. There's a lot of skill involved in building this. It's not just building the shell, but you have to have access to power, access to connectivity, as I mentioned earlier. Getting the permissions is quite difficult. So Frankfurt is a market where, depending on the submarket that you're talking about, there is no more power available, even though land may be available for another couple of years. So that also stalls the amount of actual active inventory that's available in the market. So if one goes by press releases and looks at land purchases, that paints a very, very different picture than when one looks at actual inventory going up that could be commissioned and delivered to customers. That's usually a much, much smaller number. And therefore, again, with some exceptions, I wouldn't say that on a broad basis, this is a segment where there's a lot of speculative development or a lot of an inordinate amount of aggressive pricing.
Nonetheless, if, as you say, there's been some yield compression, but realistic yield expectations might be in the high single digits, that's going to attract an awful lot of new interest in the sector, because where else can people get that kind of return these days? And therefore, I'm wondering, Catherine, when you expand overseas, as you are, you're already in Europe and you're already in Germany, how can you quantify this kind of yield level? I mean, it doesn't have to be the exact number or anything like that, but those kind of yields would attract a lot of people into the industry.
Yes, absolutely. And I think just to echo what John said earlier, in the industry, as the industry developed, you saw a lot of double-digit yields, and they have compressed in the last few years. And most of it is not only supply and demand driven, but it's also scale driven and design and densification driven. So in terms of where the cost efficiencies come to play and the design comes to play, is we went from one end-to-end architecture to 7/6. And what that really means is densification of providing capacity to the customers is done in a different way. So you're utilizing your equipment more efficiently, which allows you to have a different cost structure. So design is very important. But in our world, what we care about is the land bank, but the land in the right place and in the right time. So this is the name of the game, is to have a capacity for your customers when and where they need it. So when we think about our growth and development, it's not really a speculative outlook to just find the land that can house a shell and then you bring a power. But you also have to collaborate with your customers to understand where the power and the connectivity and that piece of land is within their footprint, within what they call availability zones, where they would be interested in having their data centers and leasing space from us. So I think it's a very complex game, which is interesting. It's not simply to have a prime real estate, but it's kind of table stake. You have to have a prime real estate. You have to have the connection to the broadband, if you will, fiber. You have to have power, and this is the different levels of power. And now it's becoming, especially in the European landscape, you have to have green power. Brown power is not acceptable anymore. So from all of this, when you put it all together in the blender and blend it out, you're still able to generate attractive returns. And on an unlevered basis, we're probably looking at a high single-digit yields in this region.
And that brings us to what Andrew said in his introduction about barriers to entry. It seems that, it is very difficult to have a cookie cutter approach to this. Almost everything is tailor-made, whether it's weighted towards the real estate, the power of the land side, or whether it's weighted to the servicing side. Jens, this is something that you must be confronted with every day, particularly in looking at sites in Germany and with your existing business there. How tailor-made does everything have to be these days?
Well, it depends much on the customer group you focus on. So separate customer groups have different demands. So if you're looking at the hyperscale sector that has grown in the past 5 years immensely and wasn't that strong before, that is very close to the classic real estate development. So the only thing you need to deliver is a powered shell, maybe. If you go into enterprise and wholesale business, customers want much more service portfolio from you. And if you go into retail, which is another large proportion of the market, they will ask almost anything that needs to be done on site or from the IT angle for their equipment from the provider. So data centers are like marketplaces. The smaller the customers get, the more service oriented the vendor has to be.
And this is also leading to a sort of division in segments within the market, from the big hyperscalers right down to much closer to the end consumer.
Yeah. That's what we see. I mean, in the old days, there was the big brand names, maybe some small local play, but today it's new providers come to the market that only focus on one customer group. And at the moment, because the hyperscale segment is growing the fastest, the recent or the most recent entrants into the market have been in that hyperscale angle.
Paul, you've set up a fund to invest in data centers in Europe. How difficult is it going to be with so many different types of data center coming onto the market and the specifics of each specific type? How difficult is it going to be for you to find adequate assets to bundle into your funds? It's a very diverse and fragmented market, isn't it?
Absolutely. And I think identifying assets is undoubtedly the biggest challenge of the fund. You know, we're fundraising at the moment, but frankly, I think raising funds to invest into the sector, whilst not unchallenging, is the easy part of the equation. Identifying appropriate assets to deploy those funds into is going to be more difficult. We're looking to move away from that sort of hyperscale end of the market into some of the more granular assets. So, as Jens was describing, probably more of that retail and enterprise style of data center, smaller lot sizes, and potentially in the core markets, but equally potentially away from. Because, as you say, there are lots of people looking to deploy capital into that prime end of the market, very attracted by the amount of investment being made by the hyperscalers and their rollout. And that's a perfectly good strategy. Why wouldn't you, when 85% of the take-up in the market is driven from there? But equally, we think there are other opportunities in the market which, whilst undoubtedly will still be competitive, may offer slightly better returns than that sort of really highly sought after hyperscale end of the market.
I can chime in on that if I may. So,
please do, Jonathan. Please do.
So in round numbers, if a hyperscale project is seeing 10% unlevered returns, some of the assets that I think Paul was alluding to, the older ones where the internet was essentially created. So in London, that would be Docklands, and then maybe more recently in Slough. And then in Frankfurt, you've got a lot of assets that were part of the Interaction campus on Hanauer Landstrasse. So if you look at German internet traffic and where DAY6 nodes reside, there's core nodes and there's edge nodes, but there's a couple of buildings where a lot of the interconnectivity happens. And if you happen to own one of those buildings, it's quite likely that you're going to be seeing closer to 30% returns. And so what drives that is customer density. So the unit pricing, if you're doing a large number of small deals, is going to be a little bit higher. But then those customers also connect to one another. And so that drives higher pricing as well, because you're saving a lot on bandwidth when you're in that environment and you're connecting one fiber from your cage to another customer's cage, exchanging a lot of traffic without having to pay the telco, for instance. So that has become a revenue source in Europe over the last 10 years. So the idea of charging for cross connects within this piece of passive real estate, this data center, has only evolved in Europe over the past 10 years, driven by initially Equinix when they bought IX Europe, and then Interaction started to do it. And so there's been a bit of an Americanization of that cross-connect pricing model that has also enhanced the returns of the types of more retail peering-oriented or customer-dense buildings that Paul has alluded to. The challenge is if you're looking to deploy hundreds of millions or billions of dollars of capital, you can't create those assets from scratch because they exist for a reason, because of where the railroads were built, where the fiber was built, the way the internet was developed in a given country. And so even though those are very high IRR investments, the volume of money you can put into it is quite finite because most of those buildings are now owned by a multinational or by a private developer. Many are not for sale. And it's very difficult to create that from scratch because you would have to take years and years to develop that customer density. And that's not a natural thing to do when you've got big customers like Amazon, Google, Oracle, Alibaba, and staring you in the face wanting to take down entire campuses, right? So if you're looking for dollar volumes of return, wholesale hyperscale is where it's at. If you're looking at return levels on a unit basis, clearly retail interconnect is where it's at. But unfortunately, those are limited, I think, in terms of the growth potential.
Yeah, and actually, I would add to that from our perspective. In the US, we have a fairly balanced portfolio between hyperscale and enterprise and retail customers. We can also think about it from public cloud providers, private cloud providers, and co-location. But when we entered Europe, we entered with our existing customers, which are public cloud providers. And that's where we've seen the growth. And it is a scale approach. So you're going to deploy minimum 4.5 megawatts for a public cloud providers versus when you talk about more of enterprise outsourcing, and you see them trying to balance their hybrid. They used to be self-build, now they're doing co-locations, and they're probably going to end up with some sort of combination of public and private cloud and co-location. And those deployments are 500 kilowatts. Maybe it's definitely under a megawatt. So you're going to have to do a lot of hand-holding and a lot of different approach to fill in that 4.5 data hall megawatts data hall. So that's
Jonathan, you mentioned interaction there. It's no surprise that after a certain time, interaction, big player though they were themselves, got swallowed up by a big American player, a big American REIT to give them the clout to come into these markets. But you raised the subject of Frankfurt. Let's talk about Frankfurt, actually. Obviously, Frankfurt is the F in flap. It has a number of natural advantages. It's close to all the banking centers and it very close to the finance world, to logistics world. But key to it, I think, its development as well is the arrival of 𝗖𝗃 as the number one internet hub in the world, of course, which has made Frankfurt the natural go-to place in Germany. Now, we've seen colossal developments there. I know what that old Neckermann building down on the Hanauer Landstraße, which I've been in several times myself in another existence, and it's going to double the size of Frankfurt's capacity itself. And Frankfurt's capacity itself is due to be 5 times last year's by the year 2025. So the numbers that we're talking about here are really huge in terms of the increase in capacity. This must have a limit, surely. Certain markets, I know that, for example, the Irish market, which is also a very important data center market, are now starting to query whether all this utter dependency on data centers is exactly what they had planned. There's certain attractions for big data centers to be there, and obviously to a certain point in Frankfurt as well. But will they be able to access A, land, B, power to the extent that they've been able to do in the past? And what are the other issues that might prevent limitless expansion in the city of Frankfurt? I mean, this question is for all of you, because I'm sure all roads lead to Frankfurt in the data center industry. Jens, I might ask you just for a start.
Yeah, just for starters, I mean, Frankfurt from an international perspective is one of those big cities, as you said, one of the tier 1 markets. There's only 4 or 5 of them in Europe. But in terms of size, Frankfurt is much smaller than London and the other big names. It's only 700,000 inhabitants. So there's 2 million workspaces with all the other surrounding cities, but Frankfurt itself is very small. So there's a limit to not only to plots, but also to power supply. And the rapid growth in the past years has created problems with the administration. So, just to give you some feeling, 30% of the energy consumption in Frankfurt goes into data centers. So it surpassed the airport that has another 20. So you see, the rest, the 50%, is for all other businesses and the residential households. Yeah. So this created problems, and the city tries to curb them and to find solutions for that by clustering certain areas where you're allowed to build data centers and others you're not allowed anymore. So there is an end to what data center buildings in Frankfurt can be. What we see is that large companies, so we call them the big five, the GAFAM, Google, Amazon, Facebook, Apple, Microsoft, they are moving out of the city because it still meets their requirement from an AZ point of view, AZ being the availability zone, so they spread data center presence across 2 data centers, or maybe 3 in a certain city. But there's a limit to how far these data centers can be apart from each other. So mostly it's 10, 15 kilometers max. But smaller cities are very happy to catch some of that demand, to get a share of that cake. So the restrictions that Frankfurt put on the sector are not there in other surrounding smaller cities that we see, that we are seeing that get some of the fresh developments, and they are very happy to have data centers as taxpayers in their municipality. So in Frankfurt, you're maybe not the first, and the red carpet is not rolled for new data center developments, but in the surrounding area it is.
Charles, could I just jump in? We've had a question which is relevant from, and I'm going to apologise for my pronunciation, but Stefan Revman. He asks, is the precarious situation of the electricity supply in Germany a problem for investors? He says, after all, we are taking more than 50 gigawatts of secured capacity off the grid in Germany, and at the same time an increase in electricity consumption of about 50% is expected, which I know electricity and power has been mentioned 2 or 3 times already. But is that a problem for potential investors or existing investors in this sector?
I think it from my perspective, it depends where you're investing in terms of it, in the spectrum of investments. I'm sure Catherine will tell us that for operators, that number one on the checklist is that availability and cost of power. So when you're developing new data centers, particularly in those prime markets like Frankfurt, as Jens has described, it's a huge issue and a bit of a barrier to expansion at the moment. But equally, on the flip side, when you start to look at existing assets, that becomes a positive if you're starting to see a bit of constraint on development in some of those markets. So that sort of adds to the intrinsic value of some of those existing assets, if that's where you're investing.
Yes, and we do see when there in increase in power demand, utility providers becoming constrained. And so we do pay very close attention to power availability. And there are some areas where that's now turning into years. So additional power could be years away. That's part of the development process. And I'll tell you, in comparison, in the US, it may be taking us 6 to 9 months less time to get power and get the construction going and permitting than in Europe. So permitting, which includes power availability, is probably the biggest hurdle for new investments. So when we look for additional land, we have a land on the contract for our 5th data center in Frankfurt area. One of the critical things that we considered is power availability before we even put any kind of analysis towards that land or any attention.
And Catherine, when you're looking at a new asset like that, how complicated is it to just for the start-off procedure? You probably have to have talks with local local authorities, local permit issuers, have fiber cable laid down to bring in. This is a very complicated process. How do you find Germany, for example, compared to some of the other markets in which you're dealing? I know you're in most of the other European markets as well, but as a big multinational company and coming into these European markets, environmental issues are very strong in Germany, and there's often pretty much resistance against almost any kind of building. What are your experiences there?
Yeah, so we are in a global business that's run locally, and I really mean it. For every project that we look at, we have to bring our local expertise, local lens, and talk to local authorities. Permitting is number one, and we collaborate with the regulatory bodies and the rules and regulations very locally. Generally speaking, I think Europe is a little bit more, it takes longer in terms of timelines, especially in the last couple of years and pandemic, to do business. But within Europe, every market is unique. So you wouldn't compare them in the same way as we look at it across US and different locations. I mean, in California, we do have lengthy permitting cycles comparing to others. But in Europe, I think Germany, we like that market, but we do find that we have to be very disciplined and very patient in the permitting and obtaining the power. On the connectivity and the fiber side for us, because most of our clients in Europe are hyperscalers and public cloud providers, they, in a way, take care of their own connectivity. And we do use our partners for connectivity, but it's not a barrier to, it's not something that we consider upfront. What's important is to be within those availability zones that our customers want to expand. And we have very close partnership type discussions with our customers as to where they want to go. So for example, we're now in Frankfurt, which is our second largest market in Europe after London, but we also potentially, there is another market in Germany, Berlin, that's becoming more and more interesting. We're not there, and we just need to work with our customers to see if there is a demand and there is interest there. Potentially, that could be something that we would look in the future.
John, and you track the shifts of these markets from being fairly established, as Catherine was saying, Frankfurt absolutely rooted as the main market. But you've seen in other markets things, for example, a shift away from London, for example.
So I'd say Frankfurt in the last 5-6 years has kind of started to parallel London in terms of just amount of interest, amount of development, and sometimes leads London in terms of absorption, not necessarily in the moment, but there's been certain times over the past 2-3 years where it's really Frankfurt and London. Amsterdam is probably the less active of the flap markets. And then Paris has kind of come into its own. All the major hyperscalers have been in Paris for a while, but the deal sizes haven't gotten into that kind of double-digit megawatt category until really the last 2.5 years or whatnot. And so, this kind of brings the point. Every market sees the same path. It's just a question of where you are on that timeline. Catherine mentioned Berlin, and that is a market where there is a lot of interest from customers. There are some developers that are purchasing land there. And it could very well become a second city. So in countries that are large enough, and so I'll mention, Osaka versus Tokyo, Melbourne versus Sydney, we've seen that. Berlin versus Frankfurt, it's plausible that could become a second city for both physical resiliency reasons. Maybe there's environmental, reasons as well. You don't want all the energy usage to be in the state of Hessen, right? But maybe elsewhere. And then there's an entire part of the German geography that's served better out of Berlin, not to mention Eastern Europe. So it remains to be seen how real that opportunity is, but there's a lot of folks that are paying very close attention to that. And if it does develop the way that many people think it will, it'll really far out, surpass Dusseldorf or Munich or Hamburg, which are kind of secondary cities and probably will remain so. And then on Frankfurt, just to kind of hit on what �ens-Peter mentioned, I'm very interested in hearing from him what the statistic is in terms of overall energy usage for all of Germany that data centers represent. It's often in the 3 to 4% range.
Yes.
Get to Singapore, Amsterdam, and then Dublin, which are kind of export markets. In other words, servers in those jurisdictions don't serve a national need, but they serve a regional need. It's often closer to 6%. And it's not surprising that the moratoria that we've seen have been in those sorts of export markets where the energy usage and the emissions that go along with it aren't necessarily serving, the domestic economy, but more of a regional need. And it's come under greater environmental scrutiny. In the local German press, whether it's podcasts or newspaper articles or whatnot, data centers have really, the profile has increased in terms of the amount of energy that they use. But I would say that the permitting situation, at least for the next several years, is in Frankfurt. If you look at Hildesheim and you look at Hanau and Offenbach and some of the newer submarkets that are going to develop, not just the existing ones that you mentioned, where the Neckermann building is, and then Kruppstrasse where Equinix, and then not far away Iron Mountain. Those are projects that are underway that are permitted. And then you've got newer developments that I think take us through, let's say, the year 2024, 2025. After that, there may be an issue, but I don't see a moratorium-like scenario for Frankfurt the way that it's suddenly.
So by expanding out to Offenbach, which is the home of several major new sites at the moment, which will come on stream in the next couple of years, you're saying that there's no immediate danger of Frankfurt losing. What I'm asking is more or less, and Catherine, you've probably had experience of this. Are you getting resistance from a city like Berlin, for example, to start with the first? Because presumably when a number of big players like yourselves set up in a city, it starts the whole process of clustering, and others start to say, particularly with Berlin's population, it's 6 times the size of Frankfurt in terms of actual population. There's plenty of water for cooling around the place and so on. Are people making already steadied attempts to set up data centers, big data centers in Berlin? Is it will it be the next place where the money goes?
We're not in Berlin, so I can't speak for that. In the way I think about Berlin is it's a potential market. It's something that if we run out of capacity, land, power, you name it, in Frankfurt, Berlin could step up. But it requires different level of demand. It requires different level of connectivity and attention from the big hyperscalers and cloud providers. But we're not there, so I can't speak to what it takes to do business there now.
Jens, you're obviously watching what happens in different cities.
Yeah, so I think coming back to what Jonathan said, so yes, I fully agree that the energy constraints that we see in Frankfurt can be managed locally. I mean, for the green energy question, there's other issues to be discussed, but from a local supply, or companies, grid providers are investing to broaden the supply in the area. So there's initiatives from 3 major transmission grid providers that just announced they will invest heavily in the area. So I think that is over time, will be managed. But what I see in terms of edge and latency development, not every demand to compute workloads will be done from one city.
Edge and latency development is right up close to the customer, right?
Yes, that is
almost container sized in size. It doesn't have to be a giant, big football field size building. Yeah.
In the old days, I mean, Germany was the edge for the US providers, so they moved out of their domestic market, moved into Europe, and this was the edge. But now, as latency issues become more and more relevant to 5G to edge play, one big city with a lot of IP gravity per country is not enough. So it will move to the edge even more. And Berlin, we heard Hamburg, we see Munich. So there will be a lot of today tier 2 secondary markets be seen. But that will be a natural development over time, where we don't have that single big hyperscale data center market only. There will be smaller enterprise, there will be a wholesale data center, but also retail data centers in the area that cater for that demand. So there is a natural development that comes with latency requirement, because latency determines DC location. So we've seen a lot of deployments go into the Nordics that already have the green power. But if you want to have the benefits of digitization in a country, you need to be aware that there needs to be local processing of data, and that can't be exported to one area in Europe alone. So it can't even stay in Frankfurt in one place in Germany. It will move out to the borders, to the edges.
But would that not speak in favor of heightened investment in cities like Munich and Berlin?
What we've seen is that large international providers move into one country and set up their presence. What I haven't seen is that one company opens up a chain of different data centers across a country where you have the same service level, you have the same contract per city, so to say. There is a local player. You have this company here and that company there, covering one or two cities, but there is no dense network of smaller data centers that specialize in edge supply.
I think that's potentially picking up on that. That's potentially, I see, where some of the market is going. Certainly, you're starting to see some providers look at that sort of regional or edge, call it what you like, network approach in the UK. And I think you'll see that start to happen in cities across Europe. And there's a bit of a turning of the wheel going on here, because we focused very heavily on data centers focused on providing for those hyperscale cloud providers and in that tier one city of Frankfurt. But actually, if you look at all data centers across Germany, sort of a plus of 75% of them are less than 10 megawatts and are in that sort of built for enterprise or regional retail sort of market, which hasn't got a lot of attention. And probably with the sort of phenomenon that Jens-Peter was talking about in terms of that regionalization of data processing, you could start to see a whole new market sort of open up for those sort of facilities.
And if that happens, Paul, are we starting to see the first signs of interest from local German investors who would go straight in as direct investors into that business, or is it something that the big international players are looking at as an aside, as an extension to their product offering?
I think you'll potentially see a little bit of both, but it comes back to one of those things you were talking about right at the beginning in terms of really, educated investors who understand the sector and understand some of the trends. Because, particularly if you start to think about buying regional or edge type facilities, not every existing facility will work for that. So I do think you need to take an educated approach, which sort of will lend itself to a smaller niche of investors, I think.
Yeah, I can echo on that. I think even two similar data centers in 50 kilometers apart from each other, one can be a very big success, the other one can be a complete failure. So there's a lot of, we call it dumb money in the market, people that want to spend money but don't know how and don't have the right network of partners to do that. So this is, people should be aware of what they're doing.
I wasn't aware that there was a lot of dumb money being thrown at data centers. I wasn't sure we were that far developed along them. Jonathan.
So I'll kind of maybe clarify a little bit. So I'm going to leave that word alone. But as I mentioned maybe 6 comments ago, yield compression, but there's also been cap rate compression, right, or multiple expansion, depending on how you view how your view of valuation, and that has to do with flow funds, right? You've got there, believe it or not, there was a time when venture capital investors were funding data center projects. It wasn't a common thing, but it did happen. And then you had, private equity investors, and then you've had kind of the shift over to infrastructure, real estate, pension funds, sovereign wealth funds. And so as you've gravitated towards these different types of pools of money, each with slightly lower return thresholds, that has had the impact of kind of compressing cap rates when it comes to M&A or new investments or targeted yields. And so that's kind of the debate is if you're going to be investing in the sector and want to see an exit, you need to have a view as to whether yield compression is going to kind of dominate from this point forward, or whether it's going to be cap rate compression. And if it's the latter, then this will be a very promising, opportunity for years to come. And so the M&A market, I'll just kind of comment. I mean, just in Europe alone, there's been a handful of deals that have been transacted. I'll talk about multiples rather than cap rates, but in the high 20s to low 30s to even high 30s on contracted EBITDA, if you include the Nordics and some of the other assets that have traded. And that's not at all unusual. So in Dallas, where Catherine sits, there was a building. This is more of an interconnect-oriented site that also went, well into that within that range. And then it's happened in Asia as well, in places like Australia. So the M&A market is quite robust. You have one investor selling to that next investor. Often that next investor has slightly lower return thresholds. And for them, it makes perfect sense to be paying, a 6% or a 5.5% cap rates. If you want to look at cap rates, there's been, shell deals, anchored by large cloud providers that are now in the 4%, 3.8% range. That wasn't the case even a year ago. So that's an interesting trend to observe as we think about, how the assets are being valued.
But that's as a result of more value added being actually brought by the tenant into the shell itself, isn't it? I mean, I have the impression that in the old days, it was easier to just present an investor with a shell with power attached, a powered shell, and take a decent return. But now, increasingly, people are looking to provide full services or added services inside, which is a lot more complicated, a lot more technical, isn't it?
I don't think the developers are adding much value. For them, it still qualifies as passive infrastructure. But, industrial assets, I think, if you look at the M&A market, have traded at tighter cap rates than data center shells. But there has been some compression. And if you've got a 15-year term with a large Seattle-based or California-based, hyperscaler, that's considered very good credit counterparty. And that's just the shell market, right? But the other things that I was alluding to when we were talking about EBITDA multiples in the high 20s, even into the mid to high 30s, those are also, it's passive infrastructure. The customers are adding the value, but the investor themselves are just really extracting the return and then maybe trying to develop adjacent campuses or additional capacity.
I mean, what you see is there are two types of valuations. One is where they look at stabilized assets and they value the cash flow, which is where you already have a fully leased data centers. But there is also a benefit of developing those assets, right? And then you generate development yields are obviously lower, but you generate value through the development of those assets. And those investors are looking at where the right opportunities for them. That's, for example, for us, we entered Europe through M&A, through acquisition of existing footprint. But since then, we've been developing organically and generating yields for our investors. And
you already have a number of assets which you have yet to develop, right?
Yes. Yeah. So like in Frankfurt, we have 3 operating data centers. We have 4th data center under development, and then we have a land under contract for a 5th data center. So we have a runway in that market.
And when you go out and look, you're looking at both existing standing properties as well as development land, brownfield land, or whatever.
It's probably more specific to us, but we take pride in our development as our core competency. So we like to develop assets. Now, valuations are not helping either because they are going up. So the existing assets are becoming more and more expensive for us to consider. But when it makes sense, like entering a new geography, it sometimes does make sense to do it through the existing business acquisition or M&A versus greenfield development.
Charles,
Andrew, yes.
We had a question earlier from 𝗂𝗃𝗗𝗄𝗧 at JLL, which touches on this point. And his question is that, does the panel ever see the sector becoming mainstream, or will it stay as a small niche as it is currently, with only a handful of transactions each year outside the M&A acquisition work?
What is meant by mainstream? I guess I would clarify that.
Well, he says that his full question is, they see much demand to invest, but simply no product. So my question would be to the panel if they see this turning, or if this sector will stay the small niche it currently is.
Yeah. So from
Please,
my
all have a go at this one, please.
Yeah.
Yeah. So let me just start, and you guys can add to it. But from my perspective, as land and power are scarcity, so I don't think we're going to find in the long term more land. I think land will continue to be a scarcity. We may be able to find the different ways, alternative sources of power, and technology will help there. But I think land is a finite resource. So I don't think we're going to see changes in that scarcity long term.
I'll have a go at it. From my perspective, I think, will it become mainstream in terms of the volume of transactions you see in some of the traditional real estate sectors? Undoubtedly, the answer is no. Do I think we'll see more than we have done for previous years? I think the answer is yes, as you see more and more locations become attractive for data centers. And equally, you start to see that as the market matures, people are looking at trying to make their transactions more and more efficient. And that may mean splitting out the real estate element from the operational element. And so I think there will be more opportunities in the market, but I don't think it will match the sort of volumes you see in some of the traditional sectors. Will it become mainstream in that it's, adopted as a target asset class by all of the major investment houses across Europe? Then my answer would be definitely yes. And you've seen that transition over, the last few years from a sector that, only a few understood to actually, it being required by most and seen as a good add to any sort of mixed portfolio of real estate assets.
Yeah, to continue, so I agree with both Catherine and Paul. So it is still a small sector, but it has been growing constantly with double-digit yearly growth rates. So it's between 14 and 17% in Germany. So it will be larger. It may not be mainstream for the reasons that were named, but there's two things that make it hard to predict. The first one being the upcoming of the edge application. So at the moment, we're only looking at these devices powered or fed by the hyperscale guys. In the future, there will be more applications running in data centers that come from domestic demand. The second is what makes it hard to predict is the Corona effect that they gave a massive boost for digitization in Germany. So I can't speak for all of Europe, but in Germany, we've seen businesses turn their attention towards digital products that never have considered that before. So that may be even a reason to expect bigger growth rates than in the past.
I have another question that I can throw out there, if you want, Charles. This is from Peter, and again, apologies for the pronunciation, Radgen. He says, which relevance do you see in an improved sustainability of data centers in the coming years? Which role do you see for waste heat usage in this context, especially outside of Germany?
I skipped this one because Peter is a fellow board member of German Data Centers Association, so I'm curious to hear what my fellow speakers have to say.
Jonathan, why don't you have a stab?
I think waste heat generation, cogeneration, those have been tried, are selectively used, probably going back 10, 15 years. I'm not aware that there's any particular new trend around that. But there is kind of this topic around ESG, so environmental, social governance, that's dictating the disclosure practices of not just listed companies, but even private companies. I think as it pertains to the data center industry, given how closely linked they are to the electrical utilities, because they represent probably the biggest or second or third biggest source of electrical demand in any given country. There's a lot that these industries can learn from each other. But the interesting thing is that the way the customers of the data centers pay their bill, they're paying for base rent, but then they're also paying for energy usage. And so the more efficient the data center is operated, the lower the utility bill is going to be. There's an alignment of interest, in other words, between the developer, the customer, and policymakers to drive data center efficiency. So PUE is a metric that we didn't talk about yet, but that's essentially the overhead tax that one has to pay from an energy usage standpoint to cool the data center to, say, 27 degrees Celsius or 22, 23 degrees Celsius. Those numbers are actually going higher over time. But the lower the PUE, the lower the energy tax, the more environmentally friendly, the less emissions a data center is going to operate at. And I'd say that there's broad alignment of interest. So there's nobody that's trying to build energy inefficient data centers. And over any given 5-year period, those PUEs are going down. The hyperscalers themselves, we haven't really talked about it on this panel, are building quite a lot of capacity on their own. They have the balance sheets to do so. And depending on the requirement, if it's heavily storage oriented rather than, say, compute oriented, it often makes sense for a Microsoft or an Amazon or a Google to build their own. There's examples of that throughout Europe, and increasingly that's happening a little bit in parts of Germany, including parts of Frankfurt. They put out their own environmental disclosures around water usage, power usage, emissions, the renewable energy mix. So the industry has a long way to go, but given how much of a target they are, essentially, in terms of the amount of energy usage, I think they've been pursuing best practices for quite some time.
There's an interesting case in Frankfurt, of all cities, but not surprisingly in Frankfurt, where a new building residential development of 1,300 houses by, I think, Instone, together with Minova, which is the local electricity provider, they're rechanneling the heat coming off the local telehouse data center to provide 60% of the heating capacity for this new housing development. That would seem to be a logical kind of extension of data centers to both, I suppose you could say, curry favor with the local authorities in terms of being good corporate citizens, but also a very practical means of diverting a lot of the extra heat that's generated from the massive servers. That's like 400 tons of carbon dioxide that is being that's being saved.
So that's low-hanging fruit. I think that sort of thing, it's great when it happens, but a lot has to fall into place in terms of where the data center is located, what the climate is. In Phoenix, there's not really a need for that, right? But in Germany, there is. And so that's why those are great case studies, but in terms of moving the needle on a more global basis, we need to focus on things like PUE, the renewable energy mix, the way that data centers are operated, how it does or doesn't consume water. I know Catherine's company has made some strides on that front. So cogen, waste heat generation is something that is an obvious example that I think is being pursued and probably should be used more, but it can't be used widespread in the way that some of these other topics I think are relevant.
You could just tell us a little bit, Catherine, maybe just tell us a little bit about how you are doing that.
Yeah, so for us, renewable energy is essential for data center design and development. And Europe is way ahead of our US portfolio. We're 100% renewable in Europe on our energy. And we're also doing green buildings. We I have seen case precedents about reusing the heat power. I think the majority of it is in the Scandinavian markets. We are exploring opportunities in the Amsterdam market. I haven't seen precedents in Frankfurt, but that's interesting that you pointed out that project. We'll definitely look into it. Generally speaking, for us, is renewable energies is number one priority, and it comes even from our customers. They really care how we do how do we provide the energy to them. So it's somewhat a competitive advantage as well. In terms of PUEs, the PUE, which is power utilization efficiency ratios, have come down tremendously in the last 10 years. I think we started maybe in the almost close to the 2s and now in the low 1s, right? I mean, it's a big, substantial strides. And it also comes with the design of the data centers and redundancy solutions. And one of the things that help PUE and efficiencies is not only just renewable energy, but also open compute versus redundancy, right? So when John is talking about storage versus compute, a storage takes a lot lower PUE because you don't have to continuously compute and crunch the data, right? And how you process that. So there's a lot of things that come to play, but I think Europe is way ahead of the rest of the world, well, at least ahead of US in terms of energy efficient solutions and demanding energy efficient solutions to do business there. But that also comes with a cost, unfortunately. So when you run a business, that doesn't come cheap.
Jens, this must be music to your ears, actually.
Yeah, we have the discussion going on. What is needed to improve the PUE even further? So you mentioned we came down from almost 2 to close to 1. That is true, but it doesn't solve the question what to do with everything below 1, because the IT still consumes energy, and that has also to come from a natural from a CO2-free source, and that's the issue we have in Germany. So heat reuse is one of those topics where we can move the barrier from traditional boundaries to new soil, and we only need to be aware that this is something that is developed locally from some single companies talking to grid providers. So there is no regulation asking grid providers to lay pipes in front of data centers, or from the city to only allow data centers where heat grids are. So this is something every company works on to give a kind of a green story to the market, because, as you say, there is protests in front of new data center developments in Offenbach. So this is something that has to be seen from a general perspective. The data centers have been the boogeyman of politicians in the past, because it consumes a lot of energy, yes, in one place, but it combines the compute that formerly stood in many smaller data centers with way higher PUEs, and so there has been a step in the right direction, but there is no end to it. You can't stop at the one. That's not solving the issue. And all the green power in Germany is certificate based, so that means that the power plants run continuously, although you buy certificates from the Nordics. In aggregation, there's still the same amount of CO2 emissions to the air. So that is something we need to watch closely. There has been an initiative, a self-regulatory initiative on the European layer, where the big cloud providers have founded an association to really do something before regulation starts, to showcase to politicians what the right steps are, what needs to be done, and that this silo thinking that everybody must stop. So we heard that temperatures from servers have a big impact on the PUE. So as long as servers are still produced that don't use that window, we will continue having problems with that.
And Paul, for you as a fund manager, with the pressure on the ESG pressure on fund managers these days, this has all got to be front and foremost of your mind as well, I guess, when you look at investments.
Yeah, I don't think we've had a single meeting with potential investors in the fund which hasn't majored on the ESG elements. And I think for anyone investing in the sector, you need to have an answer for those sort of things. I would pick up on something Jens said, which I think is really important. I don't think as an industry, data centers have been great at selling the story to the public of some of their big global benefits. There was something out from actually the British government earlier this week, encouraging businesses to move more and more processes to the cloud as part of that move towards net zero. And actually, to be able to do that, you need the infrastructure, you need the data centers. And sometimes I think as an industry, we're not good enough at banging that drum, but it doesn't take away from the fact that there is more and more power being used. I think, as Catherine said, certainly in Europe, 100% renewables is taken as a given. I think retrofitting waste heat usage into existing data centers is really difficult. I think the point was made earlier. You need the offtake for that heat as much as you need the willingness at the data center to recycle that heat. But I think increasingly you will see municipalities sort of nudge developers down that path to finding solutions around waste heat. And I definitely think it's an issue that the industry has to come up with a solution for, away from those traditional places where it's been used successfully in the Nordics, but into other jurisdictions as well.
Well, the more I hear from all of this, the more questions open up, and I'm pretty certain we're going to have another panel discussion at some point down the line to carry on with this. But I mean, it is fascinating, and it's fascinating to have four people from such different perspectives coming at this. I can see we're only at the beginning of some long, complicated development of a market sector which will have as much to do with ESG, with the PUEs, with, as you said earlier on, Catherine, the industry loves acronyms. But it's clear that, the combination of real estate plus the impact of the technology is going to keep us all very busy. Andrew, I'm going to give back to you now. I'm going to there may be one or two more questions you have, but I've got an eye on the clock there, and I don't know I know we don't normally go way over time, but it's very interesting.
Yeah, I've got a couple of quick questions, or probably not quick questions, really. One from 𝗘𝗏, who says lots of data center developments in the German market at the moment, ongoing, especially in Frankfurt. Do you see a shortage of engineering, material and construction capacities? And also a question on geopolitical or cybercrime risks. Are they a consideration for decision making for investors, developers and occupiers? And that's, let's
just take one. Take the one there. Take the first one there first, Andrew.
So the one on the engineering capacities.
Yeah, a quick round of the speakers.
Does anyone see a shortage of engineering, material, and construction capacities, particularly in Frankfurt?
So to start, I think that there always has been a shortage on people in the industry, because it's an industry that not every engineering company is focused on. But with the Corona crisis and after the recovery, all eyes on shortage of supply. That also hits the data center industry. That is no exception from the rule.
Yeah, I would echo that. I mean, we take very good care of our construction crews, if you will, and our staff and employees, because there is a definitely high risk in terms of having vendors and equipment, as well as skilled engineers, and it's all very local. So you gotta, this is one of those scarcity resources you're gonna have to manage carefully.
And I think the implication from that, and we've seen it, is an increasing cost of both people and equipment and materials, and you sort of ally that with increasing land costs. And therefore, for any development, you're seeing your input costs go up quite substantially in some of these prime markets.
Yeah. Yeah, the challenge is what we do is how to mitigate those risks is we work through multi-year or fixed price contract agreements with our suppliers and vendors.
Okay, now I've got this final quick question from Neil Campbell. Is geopolitical or cybercrime risks a consideration for decision-making for investors, developers and occupiers? We could start seeing some form of cross-border protectionism. We've seen this recently with China and their protection of data of their tech firms. Don't know if anyone's got any views on that.
Yeah,
doesn't sound like a quick question, Andrew. But
no, I know, but you know.
But Catherine, please.
Yeah, so we have to adhere to data protection and local GDPR's requirements at every market and in Germany as well. I think in terms of US has certain requirements, EU has certain requirements, but most of the data protection is it's a tailwind for data center industry because that means you're going to have to do more local data storage and local data compute. So while we are disciplined and adhere to all the requirements, those are not necessarily always negative news for the industry.
Well, that was a quick answer.
Yeah, I mean, my answer would be that it depends where in the capital stack you're investing. So if you're at the operational end, then undoubtedly there are considerations, and I absolutely agree with Catherine, there is a sort of tailwind effect, which is good. If you're investing at the real estate end, then often you've got an operator like CyrusOne who are taking that risk on, and so you're not exposed to that.
I always expected some development coming from geopolitical background that the US guys don't want to play with the Asian or with the Chinese customers. That never came to life. I've never seen that so far. So there is no restriction on business towards these geographies in the data center industry.
Jonathan, your honor.
So a lot to unpack, but yeah, I'd say there has been. I'll just kind of make a comment that during the beginnings of the COVID crisis, and you look at Northern Virginia, there was quite a lot of Chinese demand. It had nothing to do with coronavirus, but it had to do with just social networking and certain types of applications that became quite popular, like TikTok. And so when you think about all this technical real estate in one of the biggest data center markets on the planet, what was going on in the world at the time in terms of this pandemic, a lot of the real estate, obviously is used for cloud computing, but things like social networking, it could be e-commerce the next time around, but you never know what that next application is going to be. And it could be an Asian developer, it could be American, European, but I think it's often decoupled from kind of these geopolitical and then, cybersecurity. To Catherine's point, I would make the comment that data sovereignty has been helpful to the industry. If you look at the Edward Snowden revelations, the NSA back in 2014 or thereabouts. So nothing to do with Brexit. This is before Brexit, but there were large U.S. cloud providers that were establishing availability zones in places like Vienna, which probably may not have happened had it not been for drivers such as data sovereignty.
I can see there's plenty more to be teased out of all of this. Unfortunately, we don't have time today. Andrew, I'll have to give it back to you. You may have something to say to round up or to wrap up, but I can only say thank you to all our four speakers here. This has really been very interesting, very enlightening. Andrew.
Yeah, thank you, Charles. I'd just like to say a big thank you to our panelists for a very interesting discussion. Jonathan from RBC Capital Markets, Catherine from CyrusOne, Paul Lewis from Principal Global Investors, and Jens Peter Müller, who has two hats on, his Keppel Data Centers in Germany and the German Data Center Association. A big thank you to you all. A big thank you also to the audience. And as a reminder, look forward to seeing you perhaps at the next event on the 15th of September, when our next Investing in Germany Roundtable will be looking at the logistics and light industrial markets. So until then, please stay safe and a good afternoon to you all.
Thank you all very much.
Bye-bye.
Bye-bye.
Thanks. Bye.